Next video in the VPA series is we're going to talk about where's the we're going to talk about the next and the basics. So candlestick analysis. Basically what I'm doing right here, guys, I'm summarizing the book for you, and I'm actually explaining it now in video because I understand that some people learn better with video, and it's going to get better with time. Okay, so the second thing, we've already covered this in the last video, and so candlestick analysis process. Now there's 6 of them when we're talking about analyzing a candlestick, and that's going to be the next topic of our conversation. We're going to go through all of these ones right here, and our goal at the end of the series is to have tradable setups, tradable VPA setups, that if you want to be a trader, you're going to want to be having a good plan. And so we have 3 plans, trading plans for you to profit in the markets, and they are effective. I like this one as well, but once you start combining all of these together, you're literally your hit rate's going to improve substantially, and VPA is going to help you get there. How and why is it going to help you get there? And this is exactly why this video is made, is because of the understanding of how reading a candle and volume is going to help you understand and anticipate the market. Okay, so you're going to anticipate the market by looking at the candle and looking at the wicks. So the basically the candle and the volume tell you so much information about the market, and depending of course on what time frame you use. I like the daily, the weekly, the monthly, but I use all time frames, and you're going to see that in my videos coming up in the next few weeks, months. So let's get right to what the Anna's trying to say here. So this is basically in Anna's words, but I summarized it with our own understanding. So number 1 is the length of any wick. It reveals the impending strength, the weakness, indecision, and more importantly, the extent of any associated market sentiment. Importantly, the extent of any associated market sentiments. So doesn't that sound like what we just covered in our last video? The law of effort versus result. Any extent of market sentiment. In order for the trend to continue, it needs to continue in strength or in volume. And so you have to understand the thinking behind the markets, the invisible force behind the market, which is the supply and demand causes, short squeezes, bull traps and whatnot. This is how to read the market. So next is number 2. If there's no wick, it means that there's strong market sentiment in the direction of the closing price. That makes sense, right? Because the candle closed, right? I put so much emphasis on candle closes, and that's why I have a calendar for TBB charts, total bulls and bears, just to look at candle closes. And so if you haven't already subscribed to this channel, I would definitely do that, and maybe even click the bell, because I think it's very important to understand the candle closes, or at least put it on your own trading view, right? But I have a calendar that basically tells me what candle is going to close, and we have nothing for today, so that's why I'm basically making these videos right here. I'm going to try to make it all today. Yeah, at least this one, the VPA section, so stay tuned, definitely stay tuned. Next, if a body is basically narrow, it means a weak market sentiment. So there's nothing really much you can say. So if you like to use EMAs at that point, that's kind of where the market starts testing the EMA. I like the EMA. I don't have anything here yet for it, but I have a very good strategy for EMAs. If you guys know what it is, TBB, EMA cycles, fib, E waves. Anyways, let's talk about the number 4. Is a wide body. This means strong market sentiment. Okay. So again, we're going to talk about this more in candlestick patterns. And then number 5 is where the candlestick's located, at the top, the bottom of a consolidation phase. Number 6, volume validates price. So is it real or fake volume? For example, let's take a look at the chart right here, okay guys? Because in one of my videos here, I took the 15-minute chart, and I anticipated that we were going to break out right here. How did I anticipate we were going to break out? For me, it was kind of simple. First of all, this was a bear trap all the way down, and that the bulls pushed it up so much and filled so many shorts. If you guys haven't watched my video, that's how I explained it. I knew that looking at this volume right here, and the sharp move, that the shorts that got filled like right here didn't have time to cancel their orders and didn't have time to take profit or anything like that. So what happened is that they had to take their loss, and any remaining shorts either got liquidated. So they probably entered like right around, I would have to really calculate the volume if go on lower time frames, but I'm gonna guess right here. And if you guys understand the percentages of liquidation, we're gonna talk about that later. But basically, because it's kind of a long process to explain, but there's a certain percentage that you get liquidated. Like for example, 3x leverage, you get liquidated. People would get liquidated 33%, right? 5x leverage, I think, is I have to double check my notes, but 20x leverage is under 5%, right? So 5% move, and you're basically done on that position. So let's again talk about that's why it's important to really understand that. So then there's rules. So rising markets, fall volume, classic sign of weakness. Okay, basically because you want to see real deal bull traps or bear traps. Always be asking, what is smart money doing? Follow the smart big money. This is the biggest rule that I can actually highlight, right? So that's the biggest thing that I can say about this right here. And in the description, I'm going to summarize it even more, I guess, of this video. So if you're actually taking notes, you're actually being a decent student, take a look at the description. I'll include something in the description. So next is be obedient to your risk tolerance. So Anna Cooling says basically take 3-to-1, minimum 3-to-1 RRs. In the measured move, they say 2-to-1 RRs. Some people go as low as 1-to-1 RRs, which means basically the tool, right? I would say, I mean, Paul Tudor Jones, this master trader, whatever, he's like 5-to-1. That's quite a bit. So it depends what strategy you're really looking for, but I would say ride your profits, man. Follow up your profits with the stop loss. But initially to enter that trade, you're gonna want to have, in my opinion, probably a 3-to-1, but 2-to-1 if you're using Fibonacci or something like that, right? Because Fibonacci helps. In the long run, you want to trade like a casino, and that's going to be in the series. We're going to talk about that in the series. Okay, so follow the smart money, extremely important. Next, learn to maximize your profits by letting your profits run. That's kind of what we just explained, and cutting your losses fast. So having a stop loss, right? Entering the market 3-to-1 or 2-to-1, whichever suits your risk tolerance. Know your risk tolerance, right? Obey your risk tolerance, letting your profits ride, and then following up your profits with a stop loss order. Okay, you want to follow up your profits with the stop loss order. That's where Gann's technique will actually get into it. And guys, I'm reading Gann. Gann is basically this girl basically studied and summarized Gann's work, but Gann's got more, details. So let's talk more about being obedient to your risk tolerant, right? Watch for volume validation, for stop hunts, for manipulation. This is again just the thinking behind the market. You want to be able to read the market, to be able to anticipate the market. So the professionals use tactics, for example, measured move, Fibonacci, Elliott waves, to get you into weak positions by basically using your emotions, right? If you understand the Elliott waves as waves of emotions, E-waves, emotional waves, then that will do you good if you understand what each wave means. That's what I call them. I call them E-waves. So, but it's all good. Elliott waves it works too. So example, moving prices around on low volume to catch stop hunts and order fills at better prices. This is classic order manipulation. I've also seen order book manipulation where they'll cancel their orders and then they'll cause a huge run up on low volume, right? Catch your stops and then push the market down and then reverse it. That's what a wick looks like, right? On low volume. and then they just basically start selling their bags and then getting a next stop hunt. So next, in a bull market, it's better to I hope that one makes sense, because you're going to see that in real time. You're going to see that in the order book, and you're going to see that in the wick. That's what causes a wick, right? It's order book manipulation and also real traps. So let's continue here. In a bull market, that's a reversal, by the way, on low volume caused by the order book manip. I call that order book manipulation. So in a bull market, it's better to always work on the bull side, right? Be a bull in the bull markets and a bear in the bear market. Follow the trend, trade with the trend with the smart money. Be a bull in the bull market and the bear in the bear market. Remember that one. Be a bull in a bull market and a bear in doesn't mean that you can't sell in a bull market and take profits to enter a better trade, but just be a bull in a bull market and a bear in a bear market. There's no use to being a bear in a bull market. Like, it's just kind of insane a little bit, because why would you want to short for 1%, maybe 0.5%, and then the price moves upwards 5% either against you, if you weren't fast enough to take your profits. I know traders like that, but if whatever makes sense for them, right? Be a bull in a bull market, bear in a bear market. So understanding, and I don't have anything, if you can make money doing it, then so be it. But next, you want to understand the primary trend, the secondary trend, and the micro trend. There's 3 time frames that you want to be taking a look at anytime that you look at a chart. The way that she looks at it, Anna, she basically says the 30-minute is your like a highway, right? So you have a highway. She goes 30-minute, 15-minute, and 5-minute. 5-minute is your fastest time frame. That's where you kind of look at the volume. You take a look at all this stuff. Your middle highway is the 15-minute chart, which is also what the MM uses, and we're going to talk about that in the next series of video. MM is the measured move, Fibonacci, trading the measured move, 50%. Golden ratio, basically. So understand the primary trend. Primary trend is a 30-minute chart. It's a slower time frame, but you kind of see a little bit more. And so this one, in my opinion, if you go down to like a 1-minute time frame, there's a lot of psychology down there. So even the 5-minute chart, you've got to be understand that you have to use these 3 time frames, because you're going to be cool. You're going to be look, I'll just show you guys right here. So this one here, I've got a little bit different charts, but let's actually use 30-minute. So you guys understand that 30 minutes is a higher time frame, so it takes more time to move the prices, but you understand the main trend here on the 30-minute. You can see that we're kind of consolidating in a range. But if you go down to the 15-minute, it's a little bit faster. It's half of what we just looked at, and this kind of looks a little bit like a bear flag. By the way, this is one of Gann's rules right here, that you might actually want to start selling this bottom, because this is the bottom right here, and also probably lines up with other what's it called, rules and whatnot. So and then the 5-minute chart, guys, the 5-minute chart is kind of where you want to enter your trades, but this is where you can get chopped out a lot. Okay, so you really want to really understand, like like the 1-minute sometimes is just not. Actually, it's clearer on the 1-minute right now than the 5, in my opinion, but it's very choppy. Or you want to use it basically in a trend, wherever the trend is clearer. So let's say the 1-hour chart, is the trend clearer here, or is it more clear on the 5? So that's why I use the TBB charts. I like the daily chart personally. The weekly chart, the 3-day chart is beautiful. I love the 3-day chart. So you got to find your 3 charts, and Constant Brown likes to have a ratio of 1 to 4. Okay, so 1 to 4. For example, the 22-minute chart and the 88-minute chart. I think she uses that. So she would use the 22, and that would be her. She only uses 2 time frames, but you basically want, and this would be the 88. So that'd be 2. Okay. So that's why it's important to look at the candle closes, because this right here is a wick, but then you got like some huge resistance right there, right? And then you look at your 22-minute chart for confirmation, and this is basically your confirmation right here in the 22-minute chart. So you want to see what the market makers are actually using. It doesn't look like they're using that much, this time frame that much. A little bit here, right? A little bit there, but then it broke out. So I wouldn't use this time frame. I'd keep looking and filtering what time frame are the market makers using, what time frames are the bots using, and so that's what you want to do. You want to look for the best time frames to trade. Understand the primary trend, secondary trend, and the micro trend concept. Again, before I end off this video, another example would be this is what Gann uses for his charts. He uses the monthly chart. He also uses the seasonally and the yearly chart. But so this one would be the fast or the slow lane on the highway. This would be your middle lane on the highway, and then the daily chart would be your fast lane, right? So you can kind of see, are we turning here on the daily? It might look like it, so that's why you go on the weekly chart and you see, okay, there's a little bit of slowing down. We still have 2 days, 22 hours to close. That's why I like the bigger time frames, because you can anticipate. And the 3-day chart. The 3-day chart is a chart that he actually mentioned in one of his last books, 45 Years in Wall Street. Guys, if you can take a guy that has 45 years of experience in Wall Street charting and technical analysis, making millions of dollars in the market, you're going to want to listen to what he has to say. And one of his last books, basically, and that's Gann, W.D. Gann. If you guys don't know the guy, and we're not talking about the Gann fans over here. Like, he's got books, man. He's got knowledge and hidden secrets within those books. But anyways, yeah, that's how popular he is. They basically made Gann boxes and whatnot. Yeah, so the 3-day chart, he actually ends up making rules on that chart. So that's what you want to take a look at. You want to know what the market is trading based on. What are the time frames? Is it the hourly chart, 30-minute chart, 15-minute chart? What is it? Find the trend, and trade the trend in the direction of the trend. Okay, peace. Hope you enjoyed this video.